Now we've got a situation where the world is about 400% of GDP in debt. The US is 100% of world GDP in debt. It's the most indebted economy the world has ever seen. So when you've got a very indebted economy, if you raise interest rates on people, it hurts fast. And that's what's happening right now. We've got a world where it's so sensitive to rises in interest rates that it's very difficult to control economies. And central banks don't really have many interest rates. We talk about a lot of interest rate rises, but we're not even at 3% yet. So it's barely. So we've got ourselves in this very fragile system where anything can break it. And governments everywhere, we've just seen it with the UK, we've seen it with Japan. Everyone's trying to paper over the cracks to try and stop this thing falling apart. Because if it does, it's the end of the entire financial system and most of the global government bond markets. So it's an extraordinary moment in time we're living. We've got this really terrifying dynamic right now, which is a supply-driven shock, particularly in Europe, where because of Russia, they can't get access to the energy that they need, so therefore they have to pay up for it. So the energy costs have gone through the roof. The European Central Bank has already started, the governments have already started giving handouts to people and to industry to try and save them in this situation. And interest rates have gone up. Steady mix where growth is going to implode on the back of it. Meanwhile, the US dollar has gone up because there's all of these debts. If you're not generating as much income because growth is slowing down, so this is companies and banks all around the world, they start having to bid up money to get the dollars that they need for debt. The central bank in the US is reducing the number of dollars in the system. So you've got a game of musical chairs going on where the Fed is taking away chairs and everybody's scrambling to buy dollars. The first to blow up was Sri Lanka, but we've got a bunch of countries all speaking to the IMF for their needs. We've got Japan letting go of its currency to support its bond market because it's got an aging population and massive debts. We've got Europe on the cusp of doing it with its bond markets, and the UK started last week. So we've got these gigantic economies dealing with collapsing currencies versus the US dollar, rising input costs because of the issues going on in Ukraine and some of the supply issues left from COVID. So it's a really creaky, dangerous, scary situation. Corporations are going to find it harder to fund themselves. We've got massive companies like AT&T's like $200 billion in debt, and the funding costs have gone up maybe 10x. Right now, it's actually just playing out very simply in the bond market and the currency markets. So smaller economies, less of an issue right now. The actual issue is these big economies like the UK, and you can see it in the currency markets. The next potential shoe to fall here is Italy. So Italy's voted into yet a new government, but the Italian bond spreads versus Germany, so i.e. a measure of their risk, is going up. And if that gets out of control, it's going to force the European Central Bank to backstop it again, which they've said that they will do. What does that mean? That means that they will start buying more Italian government bonds. So that's more quantitative easing. See, all roads go back to the same thing, which is take all of the debt and put it on the balance sheet of the central bank. So in Japan, about 70% of every single government bond is owned by the Bank of Japan. They basically own the bond market. And one day we will come in and they will just write off all the debts, call it a debt jubilee. But usually when that happens, the currency collapses. I think watching what's happening in bond markets, rising of interest rates is concerning, and that is part of this component. The other is watching the major currencies and looking at that. And then it's looking at, I would use the ISM survey, the Institute of Supply Management survey. What we're looking at is that rolling over and coming below about 47, which marks a recession. I think that happens very fast. So the further growth goes down, the more the risk goes up of somebody blowing up. But on the flip side, the higher the probability of the central banks starting to print money again. So we're at this point where everyone's at max fear, but max fear probably means the probabilities are starting to rise of the central banks. And we've seen that again with the UK this week or last week. Everybody thinks that inflation is the enemy. Inflation is one of the most backward-looking economic indicators, and really the inflation now was baked in the cake 18 months ago. So my job in global macro analysis is to look forward 18 months and say, what will the world look like? Just the rate of change comparison of price changes is likely to lead to very low inflation numbers. Doesn't mean prices come down. But then I look at the oil price come down from $120 to where are we now? About $80. We've seen stuff like steel down 70%, lumber down 70%. Almost all commodities have come down. So those supply shocks have gone. The other supply shocks you used to be able to see in shipping prices and stuff like that. Well, shipping prices have come down. So almost all the forward-looking indicators of inflation are coming down. So now the market's fixated on wages and rents. The house prices are coming down. We're already seeing that. Demand for housing has collapsed, and housing and wages are always the longest lags. So over the next 6 months, we'll start to see them roll over too. So my guess is if we were to have this call in a year's time, inflation is closer to 2% than it is to 9%, which is a shocking turnaround in events. I think inflation goes negative. So if I'm right that growth is imploding and inflation is about to evaporate, then the probability of the central banks coming in yet again to try and support growth goes up exponentially. Let's assume I'm wrong then. The flip side of this is let's assume that the moment that there's any sort of recovery anywhere, that oil prices go up because there's a supply issue in the oil markets and some of the commodity markets like copper. Yes, that's possible, but you have to have really high oil prices to have the same amount of inflation. So could inflation be sticky at around 4 or 5%? That's where the market is talking about it on Twitter loudly, all the economists. But I'm looking at the 5-year break-even inflation rate, where inflation rate is expected by actual market participants in 5 years' time, and it's currently at 2.2%. 1 year break-even inflation is 1.75. So the market's actually pricing in something very different than the narrative. I think it's setting us up for actually a big shock compared to what people think, because we've been told inflation, 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 that's the fear. I think the next round is falling inflation, falling growth, rising unemployment. People always anchor on the past, right? There's a heuristic bias within macroeconomic forecasting, and generally it's to do with what is your big bogeyman? What is your fear, right? So everybody who's seen central bank printing, the excessive use of interest rates, who are slightly older, so particularly the baby boomer generation, their big fear is the 70s, right? Anybody who's in their 30s has never seen anything but low interest rates. There's an argument over who's right, because these baby boomers have been saying, we want to prove that we're right, that this was the wrong move. And they anchor on the 1970s saying, inflation came down after the oil shock of 74 and then went back up. However, this time around, we're missing those baby boomers we started this story with who turned 30. That we don't have that more. We've got the largest number of retirees in all recorded history. And countries like Japan, Switzerland, Italy, Spain have shown us what that means. It means they stop consuming. I remember when my father retired, he was in a good earning job and he had a reasonable amount of savings for his retirement. The moment he retired, you're faced with one thing is, how long am I going to live for? How long is my wife going to live for? And do I therefore have enough money? And so what you do is stop spending. I mean, he must have reduced his spending in the first 3 years of retirement by 60, 70% because of this fear, because nobody wants to be 80 years old and be destitute. So you become naturally incredibly cautious, which is a huge drag on growth.